How is tax calculated when selling home? Many U.S. citizens and permanent residents who own a home in Korea generally wants to know how much tax should be paid when selling home. While U.S. persons must report income from worldwide, sales of home is also considered a capital gain, which may be taxable, and it must be reported, along with the U.S. tax return, on April 15th of the year after the house is sold. There are 4 elements that determines capital gain tax for property. First, is the retention period. If the retention period for property sold is less than a year, it is considered short-term capital gain. And for property held for more than 1 year, is long-term capital gain. Depending on the retention period, the tax rate can range from 0 to 37%. Another element to determine capital gain tax is the gross income and the filing status. For property, short-term capital gain tax rate equals the ordinary income tax rate, ranging from 10 to 37%. Long-term capital gain tax rates are 0, 15, and 20%, depending on the taxable income and filing status. In order to prevent double taxation on income taxes paid in Korea, the U.S. and Korea have come up with a double taxation treaty. If you sold property in Korea, you must first report and pay tax to the NTS. If the capital gain tax is paid in foreign country, the foreign tax credit may be applied to U.S. tax return to prevent double taxation. However, foreign tax credit is applicable to the federal government, so you must first check whether foreign tax credit is also applicable in the state you reside in, or earn income. The last factor to mention that determines capital gain tax is the actual residence period of the property sold. If the taxpayer lives in the residence for more than 2 years from the past 5 years, the taxpayer can deduct up to $250,000 for individual, and up to $500,000 for married couples. To find out more details on deductions and calculations for property capital gain tax, visit our website on www.ustaxes.co.kr, or call us today for more information.